even in the demand environment right now, the backlog of orders index, Sarah, that dropped to a level not seen since the Great Recession.
Right now, but we don't have the personal income numbers yet because
we go to negative 75 basis points, a difference in yield.
I think overall slowed the response of the Fed to the inflation problem last year.
Increases in inflation this year, but that will lead people to expect higher increases in the future.
In the face of economic uncertainty, the world looks to the United States, a global economic powerhouse, for answers. As the possibility of a recession looms, the nation finds itself at a critical juncture. Will the US be able to effectively navigate the challenges ahead and stall the onset of a potentially devastating economic downturn? This video delves into the intricacies of the current economic landscape, analyzing the factors that contribute to the uncertainty, and exploring the strategies and policies employed by the US government and financial institutions. This gripping narrative unfolds as we delve into the complexities of the global economic interdependencies, the impact of geopolitical events, and the role of fiscal and monetary policies in steering the nation away from a recessionary path. With each passing day, the tension mounts as policymakers, economists, and citizens eagerly await the outcome of the countdown. Through in-depth analysis and expert insights, this video aims to shed light on the crucial decisions being made behind closed doors, the intricate web of economic indicators, and the pulse of the nation's financial markets. The stakes are high, and the implications reach far beyond the borders of the United States. As we embark on this journey, join us as we unravel the complexities, engage in thought-provoking discussions, and ultimately seek to answer the pressing question. Will the US succeed in stalling the recession? The countdown begins, and the world watches with bated breath. Chapter 1. Government Response and Policy Measures. In the face of economic concerns and the looming threat of a recession, the United States government and its central bank have implemented a range of measures to mitigate risks, stabilize the economy, and prevent a downturn. This chapter will delve into the actions taken by the US government and central bank, focusing on both monetary and fiscal policies, and evaluate their effectiveness in recession prevention. Monetary policy plays a critical role in managing economic stability, and the US Federal Reserve, the central bank of the country, has been at the forefront of implementing measures to address economic concerns. The Federal Reserve has employed various strategies during periods of economic uncertainty, aiming to boost consumer spending, business investment, and overall economic growth. One monetary policy tool employed by the Federal Reserve is quantitative easing. In times of economic crisis, the central bank purchases government securities and other financial assets, injecting money into the economy. This infusion of liquidity is intended to lower costs, stimulate the economy, and increase investment. In addition to monetary policies, fiscal policies have also been implemented to address economic concerns. Fiscal policies are government actions related to taxation and public spending. During times of economic distress, the US government has utilized stimulus packages to inject funds into the economy and boost aggregate demand. These packages often include measures such as tax cuts, direct cash transfers, and increased government spending on infrastructure projects, education, and healthcare. By increasing disposable income and government spending, these fiscal measures aim to stimulate economic activity and create jobs. Infrastructure investments have been a key focus of the US government as part of its fiscal policy measures. By allocating funds to improve and modernize the country's infrastructure, such as transportation networks, energy systems, and communication networks, the government aims to enhance productivity, create jobs, and promote long-term economic growth. Infrastructure investments not only address immediate economic concerns, but also lay the foundation for a more resilient and competitive economy in the future. The effectiveness of these government response measures and policy actions in recession prevention is a subject of ongoing evaluation and debate. However, critics argue that the effectiveness of these measures is contingent upon various factors, including the severity and nature of the economic downturn, the overall health of the economy, and the timeliness and scale of the policy responses. They highlight potential risks associated with increased government spending, such as the long-term sustainability of fiscal policies. Moreover, the impact of these measures may be constrained by external factors, such as global economic conditions and trade tensions. The effectiveness of government response measures and policy actions also depends on their coordination and implementation. Close collaboration between the central bank and the government is crucial to ensure that monetary and fiscal policies work in tandem and reinforce each other's effects. Additionally, policymakers must remain vigilant and adaptive, continually monitoring the evolving economic landscape and adjusting policies accordingly. As we move forward, the assessment of government response measures and policy actions actions will continue, as their effectiveness in recession prevention is closely monitored. It is essential for policymakers to assess the impact of these measures on key economic indicators such as GDP growth, employment rates, inflation, and consumer spending. Experts closely analyze and interpret these economic indicators to gauge the effectiveness of government response measures. For example, GDP growth reflects the overall health and performance of the economy. A sustained increase in GDP indicates economic expansion and is a positive sign of recession prevention. Similarly, employment rates play a crucial role in measuring the impact of government policies. Lower unemployment rates signify increased job opportunities and consumer confidence, contributing to economic stability. Inflation, another critical indicator, is closely monitored to ensure price stability. While moderate inflation is considered healthy for economic growth, high inflation can erode purchasing power and disrupt economic stability. Therefore, experts evaluate whether government response measures have successfully contained inflationary pressures and maintained price stability. Consumer spending is also closely observed, as it is a significant driver of economic growth. Policies that stimulate consumer confidence and increase disposable income are expected to bolster consumer spending. By assessing trends in consumer spending, experts can determine the effectiveness of government response measures in supporting economic activity. In evaluating the impact of government response measures, it is important to consider the challenges and uncertainties that lie ahead. The global economic landscape, geopolitical tensions, and unforeseen events can significantly influence the effectiveness of these policies. For instance, trade disputes and changes in international markets can impact the success of fiscal and monetary policies. Additionally, the sustainability of government response measures and their long-term implications must be considered. As the economy recovers, it is crucial to strike a balance between stimulating short-term growth and ensuring fiscal responsibility. Governments must carefully manage and make strategic decisions to maintain fiscal stability. Chapter 2: Global Economic Factors and Trade Dynamics. The interconnectedness of the global economy means that economic developments in other countries can have a significant impact on the United States. Firstly, it is important to recognize that the US economy does not exist in isolation. Economic conditions in major trading partners and global economic trends can affect the US economy through various channels. For instance, if major economies experience a slowdown or recession, it can reduce demand for US exports, which could dampen economic growth domestically. Trade policies and international relations also play a crucial role in shaping the US trade and export landscape. Changes in trade policies, such as tariffs or trade agreements, can directly impact the flow of goods and services between countries. Trade disputes, particularly between major trading partners, can create uncertainty and disrupt global supply chains, affecting the US export industry. One notable example is the trade tensions between the United States and China. The imposition of tariffs and retaliatory measures between the two largest economies has had far-reaching implications. These trade disputes have not only disrupted the bilateral trade relationship, but have also created uncertainty in global markets, impacting business confidence and investment decisions. The potential consequences of prolonged trade disputes include reduced export opportunities for US businesses and potential disruptions in supply chains, which could have a detrimental effect on the US economy. Moreover, global economic slowdowns can have spillover effects on the US recession outlook. Economic interdependencies mean that if major economies experience a downturn, it can lead to decreased demand for US goods and services, negatively impacting industries reliant on international trade. Additionally, financial market linkages can transmit shocks across borders, potentially amplifying the impact of global economic slowdowns on the US economy. The COVID-19 pandemic serves as a recent example of the interconnectedness of global economies. The widespread disruption caused by the pandemic led to a global economic downturn, affecting countries across the globe. The US economy experienced significant challenges, including reduced economic activity, supply chain disruptions, and increased unemployment rates. The pandemic highlighted the vulnerability of the US economy to global economic shocks and emphasized the need to closely monitor and understand global economic factors. In navigating the complexities of global economic factors and trade dynamics, policymakers must strike a balance between protecting domestic industries, ensuring fair trade practices, and fostering international cooperation. Engaging in constructive dialogue and negotiations with trading partners can help address trade imbalances and promote mutually beneficial trade relationships. Maintaining open markets and supporting international trade can create opportunities for US businesses and contribute to economic growth. Chapter 3: consumer confidence and market sentiment. Consumer confidence is a key factor in determining the overall health of an economy. It represents the level of optimism or pessimism that consumers have about their personal financial situation and the broader economy. When consumers feel confident, they are more likely to spend, invest, and contribute to economic growth. Conversely, during times of low consumer confidence, spending and investment tend to decline, which can lead to economic downturns. Consumer confidence is influenced by various factors, including employment levels, income growth, inflation rates, and overall economic conditions. When employment is high, wages are increasing, and inflation is under control, consumers tend to feel more confident about their financial well-being and are more willing to make purchases and investments. On the other hand, if unemployment rises, wages stagnate, or inflation spikes, consumer confidence may decline, leading to decreased consumer spending and potential recessionary pressures. Market sentiment, particularly in financial markets, also plays a significant role in shaping economic outlooks. Stock market performance and investor sentiment are important indicators of market sentiment. When stock markets are performing well and investors exhibit positive sentiment, it can contribute to economic stability and growth. Rising stock prices can boost consumer wealth, increase business investment, and stimulate economic activity. Conversely, during periods of market volatility or a decline in stock prices, investor sentiment can become negative. This can lead to a decrease in consumer and business confidence, potentially impacting spending and investment decisions. A sharp and sustained decline in stock markets can have a wealth effect, whereby consumers feel less wealthy and become more cautious in their spending, further exacerbating recessionary pressures. It is essential to understand the interplay between consumer confidence and market sentiment. Consumer behavior is influenced by both personal financial circumstances and the general economic climate. When consumers have high confidence and positive market sentiment, they are more likely to make significant purchases, such as homes, vehicles, and durable goods. Increased consumer spending contributes to economic growth and can help mitigate recessionary pressures. However, during periods of low consumer confidence and negative market sentiment, consumers tend to cut back on discretionary spending, delay major purchases, and increase savings. This reduction in consumer spending can have a negative impact on businesses, leading to reduced revenues, layoffs, and potential economic contraction. It is worth noting that consumer confidence and market sentiment can be influenced by external factors, such as geopolitical events, natural disasters, or public health crises. Unexpected events can quickly erode consumer confidence and create uncertainty in financial markets, potentially exacerbating recessionary risks. To mitigate the impact of negative consumer confidence and market sentiment on the economy, policymakers often employ measures to restore confidence, such as implementing fiscal stimulus programs, monetary easing such as tax deductions, and regulatory reforms. These measures aim to boost consumer and investor sentiment, restore stability, and stimulate economic growth. Identifying potential risks and vulnerabilities is crucial in understanding the factors that could potentially trigger an economic downturn. Some common risks include financial market instability, geopolitical tensions, trade disruptions, and unexpected external shocks. These risks can disrupt economic activity, dampen consumer and investor confidence, and lead to recessionary pressures. As we come to the end of our discussion on whether the US will succeed in stalling the recession, the countdown may be over, but the journey continues. The fate of the economy hangs in the balance, and it's up to policymakers, businesses, and individuals to navigate the challenges ahead. Thank you for joining us on this insightful exploration. Stay tuned for more valuable content, and until then, take care and stay ahead of the game.